Yeah, back in January 2018, when we were at the top of that fiscal policy-driven pop in the market, we turned negative. We were negative for almost the 422 days that the market traded sideways. But in mid-October of 2019, we upgraded our target, and we did it again not too long ago, and went with more of a cyclical profile, having previously been in defensives and bond proxies. I think the virus will peak within a month. Not terribly concerned about it. The GDP we lose in the first quarter will be gained back in the latter part of the year. We are watching, obviously, the risks, particularly cases outside of China. But when you think about the psychology of a virus or a pandemic, in this case an epidemic, people who've been pent up for 100 million Chinese for over a month, there's going to be some pent-up demand to buy things. And people are usually relieved. I mean, we got the Renaissance in Europe because of the legacy of the Black Death, obviously a different scale here. But I think we're going to bounce back. And we have all this liquidity and easing around the world and more to come. I think China's going to ease quite a bit.
Ken, what is your take on this and what kinds of stocks that I should lean toward and lean away from, given your view of the market?
Well, I think one of the big events of the day is really Apple has kind of given the green light to companies to kind of claim the virus put, if you will. We used to call it throwing the kitchen sink at it. So I think it could be a little bit of a rough quarter for growth companies, especially the big momentum companies that have been fueling the market, because a lot of them are priced not only to perfection, they're priced to euphoric perfection. So as we start seeing potentially that get pushed out a little bit, I think that investors might want to look at what I would call the sectors that your grandparents loved. You know, the utilities, the consumer cyclicals, even the large cap the dividend aristocrats, those big companies that have rock solid balance sheets. Because I really think that the market's in very good shape. The economy certainly looks well. Unless we get something really, really unexpected from the virus, I think that, as we've heard before, that we'll probably see a dip in the first quarter, but it's a supply issue, not a demand issue, and I think that demand comes back and could make the second half of the year look very, very good. So I wouldn't be abandoning equities, because if you're going to abandon them, where are you going to abandon them to? We're all a hostage to equities to get any kind of return. So I think that it's really important to kind of spread out, and if you've been making your profits on momentum and tech companies, you really want to take a look at it and understand what you own.
Barry, would you agree with that part of the market, at least?
No, I think that if we get a reacceleration in the latter part of the year, this drop in the 10-year yield would backtrack, and I wouldn't want to be in utilities. We also think that as the world grows, particularly outside the U.S., where they're having the hardest time, the dollar tends to pull back. So in a kind of a final run for a bull market, you would expect growth and value to probably work together. We've got our depressed value because of concerns about global GDP. And with growth, we've just got wads of money running around, and it's liquidity, and liquidity drives growth stocks. So I would be more positive on, for instance, tech and energy as a barbell approach to the rest of the year.
Where are you on utilities, Ken?
Well, my thought about utilities and any sector that seems to be a little bit more solid from a balance sheet point of view is that the biggest thing facing investors now is their mental capacity to riding through what will be potentially some really bad headlines for the market and maybe for all of our own safety. So during times of angst, I think the thing that keeps people in the game, if you want to call it that, is this idea that I have solid investments that don't necessarily come and go with markets. So I don't think we're going into a period where someone wants to maximize the last penny out of their asset allocation. You want to get it to a spot where you can sleep at night, so you stick with it. Because if you try to time the market, history has showed that that's been a fool's errand.
All right.